from the morning reading. Stocks have enjoyed a kickoff rally over the past 3 days, with gains every day coming off of pessimistic sentiment. That has usually been a good sign longer term, and while the low may be tested, losses should be limited or the risk increases substantially that this is a failed signal. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:12 a.m. Central Time, and I'm recording this in preparation for the market day, July the 15th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into the key highlights from today's market report. Let's see, we want that one right there. Really, essentially scratch. I mean, all four broad markets indices are just within a few ticks of being neutral, so nothing really to get excited about there. Crude oil is probably the only market that's done anything in U.S. markets of note. It's down 0.66%. Also scratches euro, bonds, and gold. So very, very, very quiet night. Overseas, not quite so quiet. China down 3%. Hong Kong down about 0.25%. Japan up about 0.4%. Germany and United Kingdom also essentially scratch. In terms of macroeconomic reports for today in the U.S., you have PPI and Empire State Manufacturing, and that one's also before the market. Capacity utilization, and oh, here we go. During the market hours, I knew there was something else going on here. Fed Chair Yellen testifies, so that could always put in a stir. And then for you crude oil traders, today's crude oil inventories day. In terms of the current volatility, NASDAQ did put in a greater than 1 standard deviation move yesterday. Other than that, relatively calm on the other indices. You look at the IV percentiles, all in the lower quartile, 13, 6, 14, and 24. IV is definitely getting crushed. Short-term VIX also getting crushed down to a 12.18. So things have definitely calmed down. In fact, if we look at the VIX, we went from a 20 area with the multiple touches here with kind of the headline risk of the Greek news to, in 2 days, 3 days, we went from 20 all the way down to below 13, and with a close of a little over 13 yesterday. So obviously not to the bottom of the VIX range. It could come off some more, but you've had quite a crush on your volatility metrics of late. And short-term volatility, it has more room as well, but obviously big change there. SPX, it should be of note, we're frankly starting to approach the upper range of the range from recent weeks to months. One of the things to kind of keep in mind here is, what are the pot odds and so forth. What happens when it gets up into this area? Do we establish a new high? Are we really that bullish right now? Is there that kind of momentum and volume? Watch those internal breadth indicators and so forth as we get into this area. You've got a lower high here, but it's a similar high. You could almost call it a double top. And, it could run into substantial resistance in that area. And then if it doesn't get through that area, what's the downside risk? Well, after having several very, very strong days, and you notice big, medium, a little smaller, momentum seems to be starting to run out here, and we could at the very least get something of a retracement coming in here pretty soon. What we really need to see, we have here a higher high over this swing point here. We need a higher low, and then ultimately we've got to take out the top of this range if the bulls are going to actually accomplish anything other than just chewing back and forth, all year. So something to kind of keep in mind there as well. In terms of the other indices, not much different. Just a quick look here. Russell up right against the bottom of that channel. We talked about this channel, that there would likely be resistance. And remember, it broke through this channel, came back up to the backside, and here we are back to the backside of that channel once again. So, what happens with small caps? NASDAQ looks very much like the S&P. Pot odds are starting to run a little low on continued movement to the upside. Dow, not quite as strong as the NASDAQ. In fact, this may be the weaker of all four of the broad market indices. So, to our daily report, not much change here. Some things have ebbed off. One important change is on the decision point, and we'll get to that in just a second. We're still calling this phase 5, the break of diagonal and horizontal support, until we establish that lower, I should say that higher high, then higher low. Will probably remain as phase 5. We have the first half of that, but not the second half. IBD status remained throughout all this as uptrend under pressure. Accumulation distribution in the S&P C minus, so a little bit of improvement there. NASDAQ a D. GMI also improved to a 6 out of 6, but still has the sell signal. But that should be flipping over, I would expect, here pretty soon if we continue to hold on to this bullishness. In terms of the decision point scoreboards, notice new signals on S&P large cap, both short-term trend model as well as PMO. Same thing on the 100. NASDAQ had a trend model, and the PMO is actually probably going to flip with one more solid day. It's really close. And then also the Dow, both the trend and PMO on the short term have flipped. So some improvements there as well. On the market posture, we continue to be mildly bullish. And you see those scores 38, 42, 37, 35. We're starting to move away from that bottom threshold. So those conditions are also improving. And in fact, the Dow could be a day or two away from going to just outright bullish if things continue without a pullback in the short term. We have taken the threshold level to level 2. And this was a level 3 a few days ago when we were pushing the bottom of that range, but it has ebbed off a little bit. There's still some warning signs here. This is not a healthy market by any means, so continue to be kind of cautionary from that aspect. We have a distribution day count at 5 on the S&P, NASDAQ a 4. We still have 3 of the 5 intermarket risk aversion indicators as risk off, but 2 of those that are risk off are rolling up. The last one is also starting to roll up, and then 2 actually went to risk on with crossovers on the recent action. So certainly improving conditions, and we wanted to reflect that. In terms of special opinions, VIX is inside the acceptable window. But consider the potential for increasing volatility and that we're still at hedge risk level 2. Cover call conditions are also acceptable, but consider position size reduction, 1-to-1 distribution between in the money and out of the money strikes, and then put selling also acceptable conditions, but consider position size reduction until you've got that established bullish posture. And what we're looking for is for a higher low to hold, and even better that we actually get out of this range and accomplish something. Now, within this, these sets of strategies, obviously, if we just simply remain in the range, put selling works beautifully. Option income strategies work beautifully. Covered call Not so beautiful, but certainly if you have the downside protection, that would be the next one in the the ranking order in terms of sticking toes in and starting to take additional positions. So kind of think about that. Put selling, option income strategies, probably the first thing to kind of be establishing as you're increasing your positions. In terms of sector market postures, we have quite a bit more green here, quite a bit more neutral. In fact, all the short and intermediate term are at least neutral. So things are definitely improving. This is also improving. We, not too long ago, had red across the 1, the 5, the 1 month, and even often the 3 month. So things certainly have bounced up and are feeling much better, in that they're getting some positive returns. We continue to focus on healthcare. Healthcare has probably been the most consistent for the year, and you see here it's the largest year-to-date return. But 1 day, 5 day, 1 month, 3 month, year-to-date, even 12-month period, it has been the hero. And as soon as you get some sort of market bullishness, healthcare tends to be the one that pops up and kind of carries the day the soonest. So that should be enough for today. As always, we greatly appreciate you liking us on the YouTube channel, or obviously subscribe to us on the YouTube channel, and then you'll get those notices each day as soon as this is published. Then Twitter, if you're following us on Twitter, retweet us to your followers, or stock twits, much the same. Greatly appreciate that. If you want more information on what we're doing, here's the website, and you can explore more detail about other activities that we have going on. Disclaimers as always, hit the pause button to review. And we greatly appreciate you each and every day in the Falcon Global Trading community. Good trading to you.